now for more. Live from Singapore, Jonathan Ko, the Standard Chartered Bank Economist and FX Analyst. So good to see you again, Jonathan. Welcome back to the program.
Nice to see you again, Kathy.
Yeah, the last time we talked on March 7th, you were here in Manila and just about to fly out. And in your meetings with the Philippine-based clients then, you said you caught a sense of cautious optimism. Does this still hold true nearly 1 month on following Trump's April 2 tariffs?
Sure. So I think for Philippines generally, it still holds true. Generally because in terms of the tariffs being implemented, I think as noted, within ASEAN, Philippines actually has one of the lowest, excluding Singapore. Secondly, Philippines is a lot more domestically driven. 78% of the economy is actually domestically driven. So it's a little bit more insulated from that perspective.
Well, let's take stock of where the Philippines now stands vis-a-vis the Asia-Pacific region. We've got Singapore and Australia at the bottom rung, the lowest impacted. And the Philippines comes in second lowest at 17%. What do the maths reveal when you compute both the direct and the indirect tariffs that would result covering all of the Philippine exports to the U.S.?
Sure. So how we analyze it is basically by looking at the value add that Philippines contributes to exports to the US. And when we say direct, it's basically Philippines direct exports to the US. And when it's indirect, it's basically the rest of the world exports to the US. And in terms of that, when we look at the total impact, it's about 0.2 to 0.3 percentage points of GDP for the 17% tariffs being imposed on the Philippines.
Right. You say in your note here, the Philippines is being negatively less affected rather than necessarily benefiting much. So what's going to keep the Philippines from benefiting much from its more heavily taxed neighbors?
Sure. So I think it's really, I guess domestically, one is over the next few quarters or so, the Philippines needs to be able to attract FDI. And I think at a moment when uncertainty is actually very high, in the world and in the region, I think a lot of businesses will be a lot more cautious in terms of investment decisions. So even though the Philippines is facing lower tariff rates, at the end of the day, because of this huge uncertainty, businesses will still be very cautious. So in terms of the benefit really coming to the Philippines, I think we probably need to wait and see.
So post-April and slower March inflation, you've moved up your timing for the next rate cut. You're seeing 25 basis points of a cut this Thursday on April 10th. So what are the nuances in your changed expectations?
Sure. Thanks, Kathy. So for me, the cut is not really about the inflation print coming in much lower. Based on growth and inflation fundamentals, I have always believed that the Philippines or the BSP needs to further ease monetary policy. What really stopped them in February was not so much growth or inflation, but more on external policy uncertainty. Now, and leading up into this Thursday's meeting, I was thinking that because of the uncertainty over tariffs, we could actually see a stronger dollar. But what happened was that we actually got a much weaker dollar. And if I were to look at the factors going forward, I mean, you have this US growth shock weighing on the dollar. People are talking about the de-dollarization theme. Over the next couple of weeks or so, we are going to get positive seasonality in terms of remittances supporting the peso. And you also have oil prices now heading much lower. I think Brent is trading at around 63. So in terms of concerns over imported inflation and this anchoring of inflation expectations, I think that will actually be contained. And that will basically allow the BSP to actually cut this week. But I would say the risk because of the uncertain environment, external policy uncertainty, would be for the BSP to actually pause.
So what's your revised forecast then for dollar peso, and what do you think is going to drive that? Because the peso right now stands at its strongest in 6 months.
Sure. So in terms of dollar peso, I mean, our view is that we think that there's potentially some upside risk for the dollar. At the moment, really, it's the US growth shock. But at the end of the day, if let's say we are going to get a stagflationary environment in the US, if inflation is going to be much higher because of tariffs, then potentially the Fed may not be able to cut as much as what markets are pricing in. So markets are already pricing in 125 basis points of cuts this year. If the Fed is actually not able to deliver that, what we could actually get is potentially a reversal in terms of the dollar higher. So in terms of Q2, our current forecast at the moment is 58.60 at the end of Q2.
Got that. Well, thank you so much for the update, Jonathan. Much appreciated. Jonathan Ko of Standard Chartered joining us in Singapore.